It'd be great to introduce Andy Pancholi, who will be discussing how history repeats with mathematical precision. Andy Pancholi is the creator of the Market Timing Report and is co-author of the bestseller Zero Hour and the Lost Coffee courses of W.D. Gann. He has extensive knowledge of the works of W.D. Gann, R.N. Elliott, J.M. Hurst, and numerous other forecasting techniques. Pancholi also specializes in geopolitical forecasting, the long-range forecasting of space weather, solar flares, CMEs, as well as earthquake prediction. He consults with some of the largest banks and institutions in the world and advises government bodies. Andy, welcome.
Thank you very much. It's an honor to be here. And let me just bring the slide deck up. Right. So thank you. Well, first of all, what we're going to talk about today is how history repeats with mathematical precision. And I'm going to reference it also to the 90-year cycle. And what we're going to do is, by the end of this presentation, you'll know how to forecast the longer-term patterns, market cycles, but we're also going to drill it down into key timing windows. And I'm going to take it all the way down to an individual day or two. So that's what we're going to try and achieve. And what I want to start off with, really, the topic is banking crises. And pretty much every banking crisis tends to lead to a market crisis. Well, why? Because obviously the banking stocks get badly impacted, and that in itself brings the markets down. However, market crashes do not always involve banks. So we can get geopolitical events that create crashes. So the two different things, the two beasts here, two different beasts. One's one's banking crises and the other's market crashes. So one always leads to the other, but it's not the other way around, is the first key point to make. And with this in mind, we want to seek out the patterns that allow us to forecast what lies ahead. And the real secret to this is about super long-term cycles. It's about knowing where to look. Now, I've brought some new information in. I know there's quite a few friends of our work, my work here. So I'm going to I've added some new stuff that I've just put together over the last week. And I'm also going to show you one of the techniques that we use in forecasting that I've never actually publicly spoken about. It's something we've just kept in the inner circle. So stay tuned and we'll show you some clear dates at the end of it. We'll show you how we drill hundreds of years of data down to a single day. And how do we do this? Well, we start off with this, my favorite thing that we keep in the office here, the crisis matrix, where so after the team, we've studied all sorts of different events and we put them in timelines. And through that, we discover a whole series of patterns. Now, as I say, some of this first part, some of you will have seen before, stay with it because I've added some bits and pieces to it. And what I need to do in order to explain where we are right now in 2023 and to assess what the risk is, both to the stock market and to the banking structure, we have to look at how these cycles work. So I'm just going to give you a very quick tour of super long-term cycles, just to show you, and you decide for yourself whether mathematical precision appears or not in long-term economic cycles. Let's start off with the 90-year cycle. It's very prolific in the commodity markets, and it also works in the stock market. Well, we're talking about stock markets today, so let's take the 1929 crash. You've all heard of that, and we're going to head back 90 years from there. But just as a recap, for those of you that are not aware, in 1929, the market made a top on the 3rd of September 1929 at a price of 386. It then plummeted by 90% down here, making a low on the 7th of July 1932. So bear that in mind. There's a big clue there. There was a major low in 1932, right? So that was just 91 years ago. As I say, the market was down 90%. But how did that crash occur in terms of mathematical time cycles? Well, if we go all the way back to 1837 to 1842, the United States had seen a massive boom based on cheap credit, specifically around the canal building around the Great Lakes. So commodities such as wheat, corn could be shipped out up through the Great Lakes, out of the St. Lawrence Seaway, across the world. So there was this massive boom around Chicago and so on, and that turned to bust. And it was also due to some of the policies of Andrew Jackson, the second national bank. We don't have time for that right now. But the point is, there was a very big top and a very big crash. The market came down 74%. So you can see how this 90-year cycle is repeating. Now, I'm going to come back to that, but the half cycle, and this is a very important point of this lecture, the half harmonic is 45 years. So if we take 1839 and add 45 years to it, we get to 1884. And we did see there a crash. It wasn't a huge crash, but it was basically a crash of around about 30%. And that was based on basically precious metals leaving America, specifically gold. So moving on from that, if we take 1929 and we add 45 years forward, so we went 45 years forward from the previous crash, or 45 back from 1929 was 1884, come back to 1929 and move forward 45 years, we then see the equity lows of the OPEC oil crisis. So some of you will remember this. I remember this well. I know you think I'm far too young, but unfortunately I do. Basically, the oil crisis there brought in this significant, this is a logarithmic chart, and that was exactly 45 years on from there. And moving forward, we were looking for a significant top in 2019, and that was just 6 weeks out. So over a 90-year cycle, 6 weeks is a very small tolerance. And of course, that came in mid-February 2020 with the arrival of the pandemic. So you can see how this cycle's unfolding. So where are we right now? Well, 90 years back from 2023 was 1933. And what happened? Well, during the first week of April 1933, there was a significant banking collapse. In fact, by the time it had all finished, over 4,000 American banks had collapsed. And the president had to. He was forced to declare a bank holiday of about a week. Okay, that was to stop other banks from collapsing. As a result of this, as a result of this, the FDIC was created, and it guaranteed people's deposits up to the sum of $2,000, which was a significant amount then back in 1933, later raised to $5,000 by the end of the year. So what happened during the first week of what happened April 2023, we saw the Silicon Valley Bank right on schedule hit the news. We saw issues with the Swiss banks, and we are still seeing issues with banks in America. There is still a degree of nervousness. So you can see that this particular 90-year cycle referenced to 1933 is repeating pretty much to within the week. And as the previous speaker, Lars, mentioned, already the government bailout this year has exceeded that of the global financial crisis in 2007. So I wanted to reference that to the 90-year cycle, but stay with me, there is more to come. Also, during the month of April, in fact, it started in March 1933, this executive order, actually it was issued on the 5th of April, was issued by the president, making everybody with gold holdings valued greater than $100 was forced to turn them in to the government, right? So, and I think they were paid, I think it was $25. And so this was some direct intervention, damaging the gold standard, obviously. And the government decided you had no option but to turn that bullion in. That was it. And that's the executive order there. That, and the cutoff date was the 1st of May. You had to have it in, and you were paid a nominal amount. Now, the Treasury were pretty smart or abusive, depending which way you want to look at it. They took that money in. They took that gold in at a certain price and then relaunched it at, I think, $32 an ounce. I think it is off the top of my head. So they immediately inflated the American reserves just like that by tampering with numbers. That sort of thing doesn't happen, does it? Stay with me. The next important cycle is the 100-year cycle, and I want you to pay particular attention to this. Just to show you why, well, the 2007 global financial crisis was exactly 100 years after the 1997 rich man's panic. We'll very quickly whiz through this. The half cycle is 50 years. We're going to be working with this in a couple of minutes from now. 1857, 1957, 1907, 2007, all saw crises. And during certainly 1907, 1857, and 2007, there were runs on banks. The Northern Rock Bank in Britain saw a significant run on it. So the next one in this sequence is, sorry, let's just run through these first, is basically 2007, global financial crisis. So masses of credit, CDOs, CDSs, and boom, the market came down 54%. 1907, the rich man's panic, also known as the Knickerbocker crisis. Again, credit suddenly dried up. And interestingly enough, JP Morgan was called upon by it wasn't the Federal Reserve then, that didn't come into 1912, 1913, but the government, the Treasury, to come and help with the crisis. And of course, JP Morgan was a prominent name 100 years later in the global financial crisis. But this crash was all about the withdrawal of credit. Go back another 100 years, and Europe is amidst the Napoleonic Wars. The United States thought they could influence this by passing the Embargo Act, which basically banned trade with the rest of the world. Effectively, they were hoping this would create blockades in Europe and it would help deflate the war situation. Unfortunately, it backfired, and that caused a massive stock market crash in America, and the market came down 90%. Now, the midpoints of this cycle, stay with me, you're doing well. I'm sorry if this is a bit mathematically complex, but I'm going to show you how we tie all this together with all these intertwining cycles in a moment. So 1957 was the 50-year cycle on from 1907 or back from 2007, and that saw a secular decline. This wasn't a crash per se. This was, I mean, certainly that's a crash pattern in terms of chart reading. But what we saw here was that every American that wanted a television, a motor car, a refrigerator could afford it, had now got one. So there was an end or a decrease in manufacturing in the manufacturing industries. So 1957, the market came down 20%, and quite a sharp correction. So heading back from 1907 took us to 1857. Now, 1857 was the biggest banking failure to date when the Ohio Life Insurance Trust failed in Cincinnati, and it was all to do with the overissue of railroad bonds. But it didn't just happen in America. We were also getting something similar happening in Britain, and Europe. So this was a global collapse in 1857. So this is quite an important point to make. Now, on the home run, and I've got to bring the cycle in because we're going to build on this one. The 72-year cycle, again, we'll start off, but we'll look at this and I'll show you how this all strings together. But we'll use the 1929 crash point. And if we go forward from there, which I'll show you momentarily, we get to 2001, which was the end of the dot-com boom. It really ended in 2000. It was the end of that first, the NASDAQ bubble burst. But if we go back, and I'll show you again, 72 years from 1929, we get 1857. So did you see 1857 anywhere else? I hope you were paying attention. We just mentioned that a minute ago. So 1929, as mentioned before, 90% collapse. 1857, down 62%. So everybody that's into Fibonacci will know that that's a pretty hefty regular correct, well, not regular, but a very precise mathematical correction. Moving this forward, there's the dot-com boom and bust. By now, everybody had got the first tranche of mobile phones, I think, and what else? Fax had all been replaced, and I can't remember. It just seems like only yesterday, doesn't it? But the market there came down 40%, basically, after its top in 2000, 2001. So what's the next one in this series? 2001 plus 72 is 2073. Now, in other presentations, I'll say make a note of that and tell your grandkids. I'm not going to tell you that. I'm going to tell you to pay attention to the year 2073 right now. And here is why. So I've never shown this in public, and this is one of the tricks to forecasting. You have an anchor point, basically, and you look back into the future, and you seek confluence zones. So just like you saw now, if you were paying attention, that 1857 appeared in both the 50-year or the 100-year cycle and the 72-year cycle, there was a confluence. I'm going to show you how we can put things together exactly from this future point all the way in 2073. So the 2073 point was derived from the 72-year cycle pattern, and working back using the 100-year midpoints. Take 50 years off 2073. Where does that take us? Do the maths, folks. That takes us right now to 2023, right here, right now. Okay, so now we're reverse forecasting, we're reverse engineering, but it takes more than one cycle to create an event. And it doesn't even guarantee an event. It's just a potential window. So we need to look to see if we can validate this. So let's head back 50 years from right now, 2023, or 100 years from 2073, and that takes us to 1973. So 1973 is within 1 year of the 1974 midpoint that we talked about earlier. And in fact, that was 73 was the top as we came into the 74 bottom as the OPEC crisis built up. So you can now see a harmonic resonance developing in these mathematical patterns. So we started off at 2073. We projected back 50 years to now. We projected back to 1973 to the OPEC crisis, and we project another 50-year cycle back. It takes us to 1923. Let's have a look at 1923. Well, that's this area circled here. There it is in the inset box, and it was quite a significant correction. But if you look back at the 100-year pattern, which is effectively this whole decade, it was one heck of a bull market that culminated on the 3rd of September, 1929. So what we're really saying is that this is a correction in the 100-year cycle, and it's not a crash per se, it's a pullback. Bear that in mind when you attempt to synthesize all this information. Now, 1923, let's head back to one repetition here, 1873. And what we see here is a significant panic. It's down 20%. Actually, that was just in America. This was the J. Cook bankruptcy, another railroad panic. And it was also coincided with the Coinage Act coming in. So there was, whether silver should be added to the dollar and things like that. That was the United States of America. Exactly 150 years ago today, 9th of May, 1873, in Vienna, Austria, there is a panic starts breaking out. The Austrian stock market collapses and spreads a contagion across Europe. So today is a trigger point day, okay, just in terms of cycles. And of course, these big cycles don't necessarily play out to the day. I mean, having said that, you saw how the 90-year cycle did. But what we're really saying is there is a cycle flavoring coming up towards a potential, I don't even want to say panic, but towards something happening. Now, let's go back. We're on the home run now. So if we go back 250 years from now, or 300 years from 2073, what we saw was in the year 1773, Britain has a major credit crisis, overexpansion of credit, cheap interest rates, everything's booming. The East India Company is a major commodity company, shipping around, imperialism's rife, and of course, Britain is a leading power. Britannia rules the waves. But what happens is that this credit finally booms and busts. And this spreads across, it goes up to Scotland, which is a separate nation with a strong industry at the time, and the Dutch Republic. So you have to remember, the Dutch were a very prominent shipping nation at this time. And of course, 1773 sees the sort of thing that Brits love, tea parties, but they didn't like this one because it was in Boston. The Boston Tea Party takes place and accelerates the path for the United States towards independence, well, for the states to unite into independence. So that was 300 years ago. So that suggests, that there's some pretty important super long-term cycles coming together. Now, these cycles are coming together, and what we've done is that we've used the 150-year pattern to backtest from a future point, and that was projected using the 72-year cycle. But also, remember, we looked at 2007 as being, part of the 150-year cycle, 1807, 1907, 2007. Let's add the half cycle to 2007. That takes us to 2057. And just to complicate things and add a bit more fun to it all, we can subtract the beautiful Fibonacci number of 34, and that also gives us 2023. So yes, we are in a window for a potential panic, but we are literally that. We are in a window. It doesn't mean it's going to happen. So how do we capitalize on this? We zoom into smaller cycles, and I just want to share this with you to show you how we can zone this down. These are smaller cycles, completely different derivation, quite complex and outside the scope of what we're talking about here. But the long and short of it is where these cycles peak, and these cycles are known in advance, as you'll see, we tend to see significant trend changes in the market. And this cycle here has a significant date, a strong date for the week ending 30th of June, 2023. So we want to mark that date into our diaries. Now, I'm not going to say this is going to be a high or if it's going to be a low. I don't know. The truth is nobody knows. And honestly, I've been looking at this long enough, more than 30 years, and nobody I know can forecast markets. But we can get an incremental edge, right? We can get gains. So what are we going to do? What we know is that if a market is trending either up or down into the end of June, there is likely to be a potential reversal. So from a trading portfolio management perspective, you start looking at protecting that position, whether it's long into that window or short into that window, because we can prepare for a reversal. So that's the first one. And the other one I want to share with you is the last week of September 2023. Now, when we look at regular annual cycles, we tend to see sell-offs into into October, that sort of area like that. So we want to mark those in our diaries, those 2 time windows, but we can take this a stage further and we can fine tune these into daily cycles. Now, these are already cooking quite nicely. And what I noticed when I was preparing for this, that there is actually a very strong daily cycle coming here. Again, you can see how these have coincided with peaks and troughs. The 28th to 30th of June itself is a strong window. Now, why is this important? It's because it's overlapping with a medium-term cycle. So what I'm really saying to you is that we really want to be looking at the last week of June, and specifically the date window, 28th to 30th of June. So that's that. Is there going to be a crash? And the honest answer is, I don't know. What is the smart money doing? So we look at the commitment of traders data, and here is the latest data in our platform that we're able to analyze. And we see that actually the smart money, the commercials, are actually long the S&P futures. Now, that generally doesn't associate with a crash because they already know about the banking crisis. They already know about this stuff. Yes, there's always a geopolitical sudden threat, and that can always impact markets. But right now, this data is saying that the chance at this moment in time, the threat of a crash is minimal. So, we continue to monitor that on a weekly basis. So basically, let's wrap it up. Forewarned is forearmed. Anything can happen. Be prepared. We are in a window for a potential crisis, but if we have a look, the COT data is suggesting that the upside is stronger. We have turning points around about the end of June and the end of September, and that's it. That's incremental knowledge. And the truth is, I don't know what the market's going to do, but I do know how we can play it safely. So be prepared. And whenever you hear this time it's different, you know that it never is, because history repeats with absolute mathematical precision. So that's it, folks. Thank you.
Thank you very much, Andy. Always impressive in terms of the mathematical precision of cycles, and in particular, the approach that you apply. I'll give you a moment to maybe grab a glass of water just to squeeze in these questions in the time that we have. Audio clear?
Ron, sorry, can you hear me okay?
Yep.
Sorry, just the sound cut out there.
Absolutely fine.
Right, sorry, just say again, please.
Yeah, brief on-point questions. Audience keen to get these answered in the time that we have. The first one is just a brief word from yourself about history, repetition versus rhyme. Is it one or the other? Can it vary?
It can vary. And, we look there at resonance on those cycles. So the obvious example that I've shown you is 1957 was not a crash per se. It was just a bull market because the industries had exhausted themselves. Whereas 100 years before that, 1857 was a massive collapse and so on. So there's a degree of repetition. The commonality is that there was a top and sell-off, but one was more severe and the other was just more subtle, if that makes sense. So yeah, arguably history rhymes more than it repeats, but I would argue that, it's the 9th of May, it's 150 years on exactly from the Vienna crash. But I don't, I haven't checked since we've been live. I don't expect a crash today. There's nothing to suggest a crash, but who knows?
Playing those probabilities and looking on the longer end side, a question on the 100-year cycle that you highlight, and I've heard you, of course, feature this before, 1929 going into 2029, is there a higher probability, according to your work, for more risk.
Sorry, do you mean
The 100-year
2020?
cycle from 1929.
Yeah. So undoubtedly the biggest windows are going to be the biggest risk window is going to be towards the back end of this decade, I would say. I think if we see anything now, it's going to be more of a correction or a pullback. And there are other factors that align with the back end of this decade, and we might not even go as far as 2029. I think that we really want to be on alert from 2027 because other cycles are coming together at that point.
Thank you. And just finally, cross-asset, dollar and commodities, what do your cycles suggest on those?
So basically, long commodities, okay? Now, the dollar is still the best house in a bad neighborhood of inflated currencies by central bankers. But, you know, we've now seen more stress on the euro. I do think, and I have written quite a significant piece in the last few weeks about the yuan, the BRICS currencies, etc., challenging, especially as we move towards, move away from the petrodollar into oil being traded in Shanghai, etc. So I still think the dollar's reasonably strong, but for commodities to head up, then there's a mix going on there. The long and short of it, I'm seeing significant commodity cycles coming together in June at the same time as I'm saying, and the commodity cycles are very strong for June. So I'm expecting big pivots in various commodities and therefore the dollar basically next month, basically.
Thank you very much, Andy Pancholi. And